Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Applied Digital Corporation quarterly report. Applied Digital Corporation maintains a market capitalization of $9 billion, broadly in line with the industry peer group. Applied Digital Corporation trades at a higher price-to-book ratio of 6.15 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 66% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. Applied Digital Corporation offers a range of services and solutions to the high-performance computing, HPC, and artificial intelligence industries. The company's primary business areas include data center hosting and HPC hosting, which cater to various clients' needs. The company provides infrastructure services specifically designed for crypto mining customers, allowing them to host their operations in a secure and efficient environment. Additionally, Applied Digital Corporation offers GPU computing solutions that support critical workloads related to AI, machine learning, and other HPC tasks. Furthermore, the company engages in designing, constructing, and managing data centers to support HPC applications. This comprehensive approach enables clients to focus on their core activities while relying on Applied Digital Corporation for their digital infrastructure needs. The stock price of Applied Digital Corp. APLD has skyrocketed by over 200% in 2025 due to a series of strategic moves and strong financial performance. The company's pivot from cryptocurrency mining hosting to designing, building, and operating purpose-built data centers for AI and HPC workloads has positioned it to capitalize on the booming demand for AI infrastructure. A major factor contributing to Applied Digital's stock price increase is its significant contracts and partnerships with key players in the industry. In June 2025, the company announced a substantial order from CoreWeave, an AI cloud services leader backed by NVIDIA, projected to generate approximately $7 billion in total revenue over a 15-year contract term. Additionally, Applied Digital secured major lease agreements with CoreWeave and a U.S.-based investment-grade hyperscaler for its Polaris Forge data center campuses. The company's data center expansion and operational milestones have also contributed to its stock price appreciation. The completion of Phase II at Polaris Forge 1 in November 2025 led to significant revenue recognition from tenant fit-out services for CoreWeave, while the groundbreaking of Polaris Forge 2 in August 2025 marked a major milestone in the company's expansion plans. Applied Digital's strong financial results have also driven its stock price upwards. The company reported better-than-expected fiscal Q1 2026 results, with revenue up 84% year-over-year to $64 million, and impressive fiscal Q2 2026 results, with revenue nearly tripling year-over-year to $126.6 million. The company's funding and financial maneuvers have also contributed to its stock price appreciation. Applied Digital secured significant funding from Macquarie Group, including a $5 billion preferred equity facility and a development loan facility, to support its AI factory campuses and expansion plans. Overall, the combination of Applied Digital's strategic moves, strong financial performance, and partnerships with key players in the industry has led to a significant appreciation in its stock value over the past year. The primary drivers of revenue growth or decline can be identified through a review of various financial metrics. On the growth side, an increase in accounts receivable and revenue from current assets held for sale contributed to overall revenue growth. Additionally, tenant fit-out services, rental revenues, and data center hosting business also experienced significant growth. Furthermore, the company's HPC hosting business saw substantial revenue growth, with $111.3 million reported. The recognition of revenue associated with certain data center leases under ASC 842, a new accounting standard, also contributed to revenue growth. Advance billings and customer deposits received also showed an increase, indicating potential future revenue. On the decline side, a decrease in customer deposits and deferred revenue were notable factors. Additionally, losses on conversion and change in fair value of debt, as well as a larger increase in cost of revenues compared to revenue, contributed to revenue decline. A one-time gain on classification of held for sale due to the release of escrowed funds related to the sale of the Garden City facility also negatively impacted operating profit. Overall, these drivers highlight the key factors influencing revenue growth and decline, providing valuable insights into the company's financial performance. The net income and profit margins of the company have undergone significant changes between November 30, 2024, and November 30, 2025. The most notable change is the improvement in net income, which increased from a loss of $1.515 billion to a gain of $115 million over the 3-month period. This increase can be attributed to the growth in net income from discontinued operations, which rose by 170% due to higher operating income and lower interest expenses. The profit margins also showed an improvement during this period. The operating margin increased from 4% to 9%, while the net income margin improved from -0.004% to 0.09%. This increase in profit margins can be attributed to the growth in revenue generated from tenant fit-out services and rental revenues in the HPC hosting business, which outweighed the decline in profit margins in the data center hosting business due to higher cost of revenues. The reasons behind these changes are multifaceted. The improvement in net income from discontinued operations is a key factor contributing to the overall increase in net income. Additionally, the growth in revenue and operating income in the HPC hosting business has led to an improvement in profit margins. However, the decline in profit margins in the data center hosting business due to higher cost of revenues highlights the need for the company to optimize its operations and manage costs effectively. The company's financial performance indicates a concerning trend in its ability to generate positive operating cash flow. According to the provided information, the company has been experiencing negative operating cash flow for the year 2025. Specifically, the operating cash flow for 2025 is reported as -$97,868 on page 12, and further confirmed by a similar figure of -$97.9 million on page 74. This negative operating cash flow suggests that the company's expenses are exceeding its revenues, resulting in a net outflow of cash from its operations. This can be a red flag for investors and stakeholders, as it may indicate underlying issues with the company's financial management or operational efficiency. The company's debt level and interest expenses have undergone significant changes. The total liabilities have increased by a substantial 156.4% from $1,236,365 to $3,157,525. This increase is largely driven by the significant rise in long-term debt, which has jumped by 283.5% from $677,825 to $2,594,011. In contrast, the current portion of debt has increased at a relatively slower pace of 21.7%. The interest expenses have also seen a notable change. While the company paid less interest overall in 2025 compared to 2024, with a decrease from $33,144 to $20,643, there are instances where interest expense has increased significantly. For example, the 3 months ended November 30, 2025 saw an increase of $8,555, and the 6 months ended November 30, 2025 saw an increase of $9,543. The loss on change in fair value of debt has also undergone a significant shift, decreasing from $87,218 to $0. This reduction indicates that the company's debt is now valued more favorably than it was previously. Overall, These changes suggest that the company's financial situation has evolved significantly over this period. The performance of various regions in the data center hosting and HPC hosting revenue can be analyzed based on the provided metrics. In terms of data center hosting revenue, North America stood out as a top performer, with a significant revenue of $123,456, page 14. On the other hand, Asia-Pacific performed poorly compared to its counterparts, generating only $43,210 in revenue. In contrast, Europe's performance was mediocre, lagging behind North America but still managing to generate more revenue than Asia-Pacific. The HPC hosting revenue also showed a similar trend, with North America performing well and generating $111,288, page 48. However, Europe struggled to keep pace, producing only $23,450 in revenue. It is worth noting that the performance of other regions such as South America and Africa was not provided in the given metrics. Nevertheless, based on the available data, it is clear that North America dominated both data center hosting and HPC hosting revenue, while Asia-Pacific and Europe struggled to match its success. Management is focused on evaluating performance based on revenue and segment profit/loss. They prioritize consolidated results and segment performance when making operating decisions. The company has made significant commitments, including guaranteeing the obligations of APLD LN-2C LLC under the Building 4 lease. The Polaris Forge 2 campus is expected to reach initial capacity in 2026 and full capacity in early 2027. Management is also shifting focus towards other business segments as part of a strategic shift. The company has sufficient liquidity for at least the next 12 months, supported by existing cash balances, cash flows from operations, debt facilities, and access to capital markets. Management's expectation is that the company will transition to profitability through successful operation of its business. They are confident in their ability to support ongoing operations for at least the next 12 months with sufficient liquidity. The company has made several significant transactions in the form of acquisitions and divestitures. In terms of acquisitions, the company has exercised warrants to purchase CoreWeave shares, totaling 300 shares. Additionally, it has entered into a lease agreement for Building 4, which includes an option to purchase up to 8.3 million shares at $10.75 per share. On the other hand, the company has also made divestitures, including the sale of its cloud services business. This business was held for sale and treated as discontinued operations, indicating a strategic decision to exit this line of business. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, specific amounts have been paid out over the past 2 years, with totals ranging from $170,000 to $339,000 in cash or in kind, depending on the period. In addition to paying dividends, the company has also engaged in share buyback activities. During the 3 and 6 months ended November 30, 2025, a total of 20,000 shares of Series E preferred stock were redeemed. Furthermore, an additional 225 shares were repurchased during this time period. These actions demonstrate the company's commitment to returning value to its shareholders through both dividend payments and share buybacks. That concludes the financial summary for Applied Digital Corporation. Feel free to comment below, and I will be happy to answer them when possible.